A stock price can skyrocket in response to a headline, making the ticker signal a sense of certainty. Moments later, another headline can reverse this trend, causing the same company to seem suddenly more affordable. This volatility arises because price reflects sentiment, while value is anchored in future cash flows and levels of uncertainty. When these factors are overlooked, investment decisions shift from prudent ownership of a business to mere speculation on market behaviours. Paying more than an asset's intrinsic worth transforms investing into a gamble where timing overshadows sound judgment. Over time, this pattern leads to overpaying during market highs and panic selling in downturns. Managers also encounter confusion when deciding whether to buy, build, borrow, or return resources to shareholders. Without a firm valuation foundation, appealing growth stories and marketing slogans can overshadow disciplined assessments and necessary trade-offs. The following sections will explore intrinsic value, relative pricing, life cycle influences, and unique situations like banking. This video draws inspiration from The Little Book of Valuation by Aswath Damodaran, so consider subscribing for clearer insights on investment decisions. Valuation begins with a key principle: never pay more for an asset than its true value. This principle stresses the importance of distinguishing price, which is visible, from value, which must be derived from fundamental analysis. Intrinsic valuation connects value to anticipated cash flows over time and gauges the perceived uncertainty of those cash flows. Relative valuation assesses how the market values similar assets by utilising multiples and comparisons with peers. One investor might chase trends while another calculates cash flows, treating headlines as mere background noise. The latter approach seeks to minimise risks associated with market fads by emphasising the asset's potential performance. Employing both methods enhances decision-making since each can reveal errors that the other might overlook. A stock that appears inexpensive compared to peers may still be overpriced if its cash flows fail to justify that price. Before selecting a valuation model, clarify the definitions of cash flows, growth, and risk as they pertain to the business. Next, evaluate whether the market comparisons align with or contradict the intrinsic valuation you've established. Discounting aligns future cash flows with today's value by accounting for time, inflation, and the likelihood of shortfalls. The discount rate factors in expected returns, anticipated inflation, and a premium for the uncertainty associated with timing cash flows. In a discounted cash flow analysis, you can appraise the entire business using cash flow to the firm and the applicable cost of capital. Alternatively, equity can be valued directly through cash flows to equity and the relevant cost of equity for that investment. Dividends represent one option for returns, but buybacks and undistributed earnings can mask what owners might have received. Free cash flow to equity captures net cash after taxes, reinvestment, and debt obligations, regardless of the form of payouts. Growth is closely tied to reinvestment since increasing cash flows typically necessitates capital expenditures or enhanced working capital. Assuming high growth without clearly outlining reinvestment requirements results in fragile estimates that are often too optimistic. Begin with clear definitions of cash flow, then develop conservative forecasts and select a terminal value that aligns with the company's maturity. Opt for the simplest model that fits the circumstances, as additional inputs can amplify errors instead of reducing them. While multiples may seem straightforward, each one is influenced by growth, risk, and profitability in distinct ways. A beneficial practice is to pair every multiple with its corresponding variable, the key driver that provides context. In price-to-earnings ratios, expected earnings growth and dividend payout are crucial, and increased risk typically lowers the multiple. For enterprise value to sales, operating margin and reinvestment requirements dictate the valuation of sales. Comparables should be firms with similar cash flows, growth potential, and risk profiles rather than simply sharing an industry label. When data distributions are skewed, medians often paint a clearer picture of typical multiples than averages influenced by outliers. Mismatch indicators are essential, such as low price to earnings with high expected growth or low enterprise value to sales with strong margins. These indicators highlight potential candidates, but you still need a compelling narrative that can be quantified. Create a concise peer group, adjust for relevant variables, and clearly outline what assumptions could render the pricing inaccurate. If this framework helps you assess multiples more efficiently, consider subscribing for additional practical valuation insights. Companies evolve with time, so the key value drivers for startups differ from those for established firms. Early-stage companies may have minimal history, low revenue, ongoing operating losses, and a significant risk of failure. Intrinsic valuation can be challenging, as cash flows may be negative and future projections are uncertain. Factors like survival probability, future revenue growth, and target profit margins become crucial when historical data is scant. Some analysts rely solely on narratives, while others convert stories into concrete revenue forecasts, margin expectations, and risk assessments. This disciplined approach reveals which narratives necessitate implausible market share or unrealistic profitability to succeed. Different factors dominate throughout a company's life cycle, from growth and margin expansion to risk of downturns or defaults. A clear overview of various drivers shows that young firms prioritize survival and growth, while declining firms require thorough default assessments. Break down the business narrative into quantifiable numbers and be ready to revise the story as new facts emerge instead of defending outdated views. Accept uncertainty as a given and diversify across multiple, undervalued estimates to prevent one failure from derailing your strategy. Special scenarios demand a tailored approach because conventional inputs struggle to apply to banks, cyclical companies, and firms with significant intangibles. Banking regulations and accounting standards shape the industry, viewing capital narrowly as equity for regulatory calculations. Deposits act as raw materials for banks, complicating the line between debt and operational funding. Cash flow reinvestment metrics can mislead, because investment often focuses on talent, systems, and branding, rather than physical assets. For cyclical and commodity businesses, earnings fluctuate with the economic cycle, so normalized earnings provide a stable comparison metric. One strategy involves forecasting the cycle, while another emphasizes maintaining low-cost reserves, operational efficiency, and utilizing hedges. For firms that thrive on intangible assets, value is derived from brand reputation, skills, and human capital, yet accounting often categorizes these vital investments as mere expenses. This misclassification can lead to an underestimation of both earnings and capital expenditures, so analysts need to adjust their assessments to accurately reflect economic returns. Align the valuation method with the business mechanics, then focus on observable drivers that can be updated as new information becomes available. Continuously ask yourself what must be true for the value to remain valid, and be prepared to adapt swiftly when the fundamental drivers change. Valuation isn't a single figure, it's a disciplined approach that connects business realities with pricing decisions. A sensible practice merges fundamental principles with humility, recognizing that estimates can be flawed even if the methodology is sound. Throughout the discussions, core levers like cash flows, discount rates, growth reinvestment, and relative multiples became recurring themes. Adjustments for life cycles and special situations demonstrated that key drivers evolve due to age, sector constraints, and accounting regulations. These insights can lead to better decision-making, as you shift from relying on gut feelings to rigorously testing your assumptions. They also minimize regret, since each buying or selling decision is linked to a clear narrative and a structured set of numbers. Begin with a simple model to value a single company, then compare it to its peers using a carefully chosen multiple. Document your biases first, and revisit the valuation when new information alters cash flow expectations, rather than just sentiment. Over time, transforming narratives into numerical assessments becomes habitual, clarifying what you own and the reasons behind those choices. Stay engaged with this journey by subscribing for ongoing practice in applying these valuation principles to real companies and actual market prices.